Right, okay, I think it's time to kick off. Hello and welcome to this month's Investor Academy session. We're hot on the heels of yesterday's pitch event, so hello again to everyone who was on that call. I'm Sarah Turner. I'm joined this evening by Simon Hopkins, who's my co-founder here at Angel Academy, and Michelle McQueen, who's our network manager. And of course, our two brilliant speakers this evening. We have Victoire de Lavigne from global Fintech firm Portage Ventures, and Alex Hirsch, a very experienced angel investor with Angel Academy. As usual, to talk to us and ask questions, please put them in chat and we'll make sure the panelists see them. But before we kick off, just a little bit about us. So Angel Academy exists to close the gender gap in startup investment, both the lack of investment going to female founders and the low number of women participating as angel investors. So we're a mainly, but not only, female angel network. And collectively, we backed over 40 businesses through more than 63 rounds of investment. I think it is now possibly 64. In 2021, we invested in 15 startups and we helped those businesses attract nearly £20 million between them from Angel Academy, other angel investors, VCs, EIS funds and family offices. And 2022 has got off to a very good start. So we've completed 3 transactions so far. Just a very quick shout out to our sponsors. We're very lucky to have some really good sponsors supporting us. They advise both us and the founders that we back. And if your company would like to get more involved in this very exciting space, please let me know. We'd love to have some tech and marketing sponsorship. But back to tonight's fun. So hello, Paris. Hello, London.
Hello.
I would like to introduce
Hello.
Victoire and Alex and actually hand over to them to introduce themselves and start their conversation. They're going to talk between themselves for a bit, but we have plenty of time for questions as well. So please put them in chat as we go along. But over to you two.
Victoire, please start. You go first.
Okay, thanks. Well, good evening, everyone. So I'm Victoire de Lavigne, and as Sarah said, I am part of the investment team at Portage Ventures. Maybe a quick word about Portage. We are a global fund fully focused on fintech and insurtech companies. We are very thesis driven, and we look at subsectors like wealth management, payments, infrastructure fintech, insurance, cryptos. We are currently investing out of the third fund, which is 625 million USD. And we invest from seed to Series C, so ticket sizes between 1 to 30 million on average. And we are, global funds, so global team. We have people in Canada, in the US, as well as Europe. And as you can tell from my accent, I'm based in Paris. And yeah, we invest globally on the regions we cover.
That's great. And I'm Alex. Many of you will, especially the Angel Academy member, we will have spoken in the past. Representing myself as an angel investor, I've been with Angel Academy. I think the first conversation, Sarah, we had in 2015, and it's over time, it's accelerated somewhat. So in the beginning, it was pretty much anything that tickled my fancy, but over time, focusing increasingly on fintech. That's also where I've got my pre-angel career. So I feel that these are the companies and the pain points that I can understand the most and that I find the most fascinating. But I don't want to jump too far ahead because we're going to talk about investing in fintech. And I've already given you a sense of how I got to the sector, but Victoire, maybe you talk a bit about the investment thesis and how you approach that field.
Yes, personally speaking, I came from a generalist fund. I've been in the VC world for 4 years, and I decided to join Portage 8 months ago to specialize myself on fintech topics. Honestly, this is one of the topics I like the most, and so that's why I wanted to join Portage. We are, as I said earlier, like we are very thesis driven. It's super interesting to be a global fund because we get to look at models and subsectors on a global basis. So we would look at business in North America and compare that to businesses that would be similar in other regions. We look at, anything related to fintech and insurtech, so very wide scope. And yeah, investing from seed to Series C. So, we can actually look at a company a bit early on, and if we feel like, we wouldn't be the right partner early on, but we could definitely speak to them again and follow the journey down the line.
Mm-hmm. Okay, no, that's very interesting. From my side, I obviously like businesses that are addressing pain points that I can understand. So from the time in banking, I know that banks are pretty much everything except efficient. So there are a large number of processes that can be automated, that have to be automated, and everyone's better off, including the people handling that one. We're obviously coming in anywhere between the earliest pre-revenue stages. And I have to say around about Series A is when it becomes difficult for me as an angel to participate, because that's when the focus changes. I'm obviously looking to be relevant to the company, to help the company, to bring more than money to the table, and but to get the interest of the founder, the amount of money that I can personally contribute obviously has to be relevant to the business. And that reflects the return expectations that I'm having on both sides. So a lot of the time people ask VCs and angels, or what is the next unicorn, or what is the next 0 to 1 company? And I'm unfortunately very boring when it comes to that. I think if you get the right valuation at the early stage, then it doesn't need to be a unicorn. And especially from an angel perspective, it's very unlikely to be a unicorn. It's more likely that we come in at the low mid-single digit level, and then along the way, before the IPO, we either have a trade buyer or financial buyer come in. But that doesn't exclude that obviously it can go all that way. So what I'm trying to say is it doesn't have to be necessarily businesses that aim to shoot the light out, but it can be very steady, very reliable revenue generators that are very attractive for our profile. Victoire, how do you look at that? You're coming in a bit later than we do.
Yes, exactly. Well, the first thing I would like to say, is we really like to work with business angels for the simple reason that usually we find business angels to have a lot of domain knowledge, to be, experts of their topics, to be ex-head of, and that's really bringing a lot of value to companies. And we also believe that they are the right partners for pre-seed, where we probably wouldn't be the right partner. That's why we start in seed. Mm-hmm. And well, I think I'm going to answer what you said in like 3 parts for Portage specifically. The first thing is, the standalone portfolio strategy at Portage, we are very unit economic driven, and even more so today in the current macro environment. And if we look at a business that can't get break even if it's in a long time, it doesn't have to be like the year after, but if we can't see a trajectory to profitability, it's not going to be super sustainable, and so we probably would stay away from this company. Maybe the second thing I would like to say is, in today's current macro environment, we tend to be focused on B2B businesses, mostly because B2C, well, without marketing spendings, there is basically fewer growth. It's a bit harder to reach growth objectives. So as of today, we prefer B2B fintechs. And, you know, we also have, you know, this is not our money. As a fund, we are investing LPs' money, who are our investors. And so we have a financial duty to them to justify valuations when we first invest, which is a bit different from a business angel, because the business angel is going to invest his own money. And so he will be able to look at companies on a deal by deal or line by line basis, as opposed to us that, you know, we look at a portfolio level. So if we go back to our LPs with, you know, a company that made a 2 or 3 times multiple, it's a bit disappointing. So, you know, at the end of the day, the winners are going to drive the portfolio performance. But on return expectations specifically, it really depends on the maturity of the company. So if it's a pre-seed or seed, mostly for us, you know, we can accept high risk because it comes with high return potential. And if we invest on later stage deals like up to Series C, then, you know, it's a bit lower risk because they have started the trajectory. So in that case, we can accept lower returns as well. It really depends on the maturity of the business. And maybe one thing I would like to add is, you know, an advice for the audience today. I think it would be really good to talk with your potential investors before closing, just to make sure you are aligned on, you know, expectations and on the same page on the trajectory that you're going to work on, your roadmap. And I think it's super important to have that in mind before the investment.
Victoire, you mentioned portfolio earlier. Do you have a top-down idea of the perfect portfolio shape, or is it a collection of attractive opportunities?
So, I mean, it's also going to respect the maturity of the fund. We are, as I said, currently investing out of the 3rd fund, and we just announced the closing of the fund, but we started deploying this fund a year ago. And so what we do usually is, you know, we can invest in early companies in the first 2 years, but then afterwards it's going to be a bit harder for us. So we'll focus mostly on Series A, Series B companies, just to respect the maturity of the fund, because we also need to think about exits. So yeah, that's mostly how we look at things.
Yeah, it's I would like to say that as an angel investor, we have a very clear idea ex ante what we would like to invest in, but that's unfortunately not how the nature of the pipeline works. So if there is an attractive opportunity and it is similar, well, not identical, but if it's similar to existing holdings, then we will pursue them. And also sometimes there are cross-fertilizations in there, so that is quite exciting. But I mean, it's definitely changing rapidly. So what we've seen late last year is there was almost exuberance, so that there were proactive interests in some of our portfolio companies. That essentially it was it felt like a first-hand experience of pray and pray, and that has somewhat cooled down now. I've seen an article just today that saying that Q4 was one of the strongest quarters. Sarah just mentioned Q1 was still very strong, but my experience is that the questions are now getting harder, and that also it's becoming a lot more difficult to raise funds. But on the other hand, we're also getting a lot more cautious. I don't know, Victoire, how do you see the current environment?
Yeah, I completely agree with you. What we observe as well in the market is it's always starting in North America and then it expands towards Europe. So there's a lag between North America and Europe, I would say like 6 to 9 months up until, you know, behaviors change. And yeah, definitely agree. 4Q last year was very extreme. It's starting to be a bit more reasonable, and we see investors being much more focused on unit economics, starting to look at profitability trajectory as well as runway. So yeah, a deal that would have been closed in a few, at least like, you know, receiving a term sheet in 24 hours or 48 hours, that's no longer the case today, which, you know, I think it's a good thing, because an investment really is a marriage. And so I think also for the entrepreneur, it's super important to know your investors, to make sure you're aligned, you share the same values, because it's going to last for a few years.
Yeah, absolutely. And speaking to other investors, the question was not whether that investment was going to be a unicorn, but how quickly, how easy it would happen. And there were a fair few studies, amongst other by the Professor Strebulaev in Stanford, showing that the time to unicorn was just dropping dramatically, and that's obviously not a sustainable process. So that is, we're now seeing a lagging effect of the declining valuations in the listed market, and arguably that's an opportunity for angel investors, because a lot of the investments that we're looking at are focusing on structural changes. So they are changing the industry. They're not targeting the discretionary income. They're not focusing on consumer consumer sentiment, but they are helping financial services businesses become more efficient. And for as long as the predominant model will still be that we need banks, there's a lot of opportunity out there, regardless of what the current macro environment is out there. But what are the businesses that come to mind? What are the exciting opportunities that you've been working on the last couple of months or even years? I mean, what are you particularly excited about?
I mean, so one thing that's super interesting, again, as you know, global funds, that we get to work on thesis, like, because we have this global view, we tend to really deep dive in subsectors. And maybe one example that comes to my mind is on the insurance field. You know, we looked at different geographies, and we looked at it, you know, through the value chain. And that's also going to be illustrative of investment choices that we've made. But, you know, like taking the example of health insurance for employees, we looked at France, and there were no MGA whatsoever. And so that's why we decided to invest in a full stack player called Alan, that now is one of the French unicorns. Another example in the same sector would be, you know, like on digital brokerage businesses. We looked at different geographies, and what was super interesting about Germany is that the end customers in Germany are never directly in relationship with their insurers. They love to go through brokers. That's just the way it works. And so we were looking for a model that would be fitting there. And that's why we decided to invest in Clark, which is a broker in Germany that follows, you know, just the usage on the market. And maybe another example is, and that's really trendy, like cyber security. We looked at a lot of solutions. It's been a bit difficult to pick one specifically, because, you know, there are a lot. It was difficult to build conviction on, you know, the SaaS itself on security. But we also looked at insurance in this field. Today, we don't think there are many solutions, so we are still looking. And we also believe that there is not much capacity on the reinsurer side, but that's definitely something that we keep a close look at.
Okay, that's quite exciting. I'm obviously, with my accent, I've got German background, and I know how tricky it is to get insurance there. And the Lord Sugar of Germany is a former insurance broker, so that's you're definitely touched on a pain point for the average consumer there. And from my side, I mean, obviously, I can talk about the company ScaleXP until the cows come home. Why am I particularly excited about this company? It's because I was there when preferably at 6, 7 o'clock in the evening, someone comes to the CFO or a financial analyst and says, we need a deck for tomorrow that summarizes the performance. So Scale in this case is helping to automate that. So rather than having this poor analyst sit through the night and produce numbers that are probably faulty, automate this process, just link it into the databases that the company is using, and it's just freeing up the decision makers' time rather than keeping them busy with copy and pasting numbers from an Excel sheet that then sometimes are not comparable. But you also mentioned cybersecurity, and interestingly, for me, Fintech has a lot to be with cybersecurity, because a lot of the banks' processes, where the banks are at their least efficient, is when they need to worry about data security, about ID management and the likes. And that's obviously where the company called Nuggets is very exciting. That's also using the blockchain technology on the first level. We're going to touch on that later. But that is one of the companies where when we looked at that, we said, this is our opportunity to learn from the founders, to learn during the due diligence, but also to be involved in a field of the internet, and I just say X.0, because by now I've lost track whether we are at 2, 3, or probably since I last checked 4.0. But back to my more pedestrian kind of style, I'm also a big fan of companies that help the people that we know, that help processes that we know. So a lot of us are entrepreneurs, or at least helping to run companies, and the tool Fiscal is helping to automate the expense and the bookkeeping process. And then last but not least, I remember being a portfolio manager when the pandemic first hit, and that was in March 2020, and a lot of pressure comes in. A lot of people are having a lot of demands. And I was thinking, wouldn't it be wonderful if we had any kind of crutch that helps us avoiding the biases, these brief moments of panic, these brief moments of, again, exuberance. And along comes Behavior Lab, which helps analyzing biases, and which goes through the trading history and tells us what we're particularly strong in. And so those are the points where I feel I can bring things to the table, because I understand what the clients are looking for, and obviously that create a confidence in the conversation with with management. Because I said it at the early stage, one very important aspect that we like to bring to the table as angels is obviously that we have something non-financial to add. And so I think that is a question that I would like to ask you. Is that a factor that is very important to you, or what are the themes that are dominating your investment thinking?
Okay, so that's almost 2 questions.
It is 2 questions, but they're completely together.
So, well, maybe, things we really like when we meet with a new team. Well, I just said it, really, like the first thing really is the team. Like that's key, especially when you invest early stage. So we like repeat founders, or we like like doers who have domain knowledge and expertise, and it could be someone that worked in a corporation for 10 years and became credit expert or payment expert or cross-border expert. So yeah, this is definitely something we are super keen on. The second thing is, well, the size of the total addressable market and just the size of the opportunity, as well as timing, like why now, like why is it the right time for this company to launch or to grow.
Mm-hmm.
And the third thing really is differentiation elements. Like it happens quite often actually that founders will pitch their idea, but it sounds so similar to competitors X, Y, Z, and so it's super important for us. Well, first of all, to feel that there is a strong vision, but also the founding team to have a good understanding of the competitive environment. That was mostly on things we like. I don't know. I would love to hear about yourself, Alex, and then we can take the second question.
Yeah, how we look at that when we can add what we can add. It depends, and it's very much personal preference. So I have to say it's wonderfully interesting to just dive into a new sector and learn about the sector, learn about technology, and afterwards it feels very rewarding. On the other hand, I've personally found that I have overlooked things that may have been obvious to someone who's been active in the sector. So if you enter, for example, a new market with medical equipment, you will have to build significant inventory there. And if the sales projections are faulty, you suddenly have a cash flow problem. Now I know, I didn't then. And that's an investment failure along the process. That's something where I feel a lot more confident in the areas that address especially the investment processes that target the investment reporting spaces and the internal processes of the of financial services organizations. And it, as I said, it keeps us much more relevant, because we'd be lying if we said we're bringing untold riches to the table. If they believe us, we shouldn't be investing in them. If we tell them they shouldn't take our money. So it goes both ways. So the other part is obviously, is there a rapport? Are the founders and management teams open to share information? Do they want to talk to us? Do they welcome questions and potential criticisms? That is obviously also very important, regardless of the industry that we're looking at. So I was recently looking at an opportunity that ticked all the other boxes, except that it was almost impossible to get through to the founder. The data was never forthcoming, and even any kind of reply took several days. So that is obviously something that is very important to me. But now we probably should be talking about the second part of that question.
Yeah, so the second part was, what do we bring more in addition to the checks? So I'm actually going to follow on what you just said. It's the same for us. If we can't create a relationship with the management team, and if we can't really find, the tangible value that we would be able to bring in the next 12, 18, 24 months, and even later, if it's not obvious, then, it's almost a yellow flag or red flag, because even if it's a really, really good business and we probably are convinced that they will do well, this really needs to be part of the equation. And when we invest, it's really because we believe we are the right partner for the company and we can materially help. And maybe an example from our portfolio company is, we have invested in a company based in Canada called Dialogue. And the first 10 clients they have signed with were actually introduction that we made for them. And when this is obvious to us, it really is much easier. Second thing I would say is, as I said earlier, like pre-seed is too early for us, except in a very few specific cases where, I have an example in mind, which is called Achille. It's a full stack infra in France. And we invested pre-seed, but that was a large round, and we invested because they needed someone with domain expertise on insurance specifically around the table, even though they were pre-product, pre-revenue. So in such cases, it would make sense. And yeah, in addition to the investment team, actually, it's fully part of the Portage value proposition. We have what we call the value creation team, as well as the partnership team. So value creation team are full-time experts and doers who spend their days and sometimes nights supporting the founding teams in our portcos. So we have a CTO, we have a head of cybersecurity, we have a leadership coach, we have a VP sales and marketing and growth experts. And this is like super, well, first of all, the founding teams are super happy to work with them. And we also, rely on them on due diligence when we move forward with companies. We are super happy to have their expertise as well. And the partnership team, so they are building bridges between the portfolio companies and our investors. And that actually led to I think that was like 20 to 25 million additional revenue that was signed on the portfolio level.
Yeah, that's interesting. That's interesting. Yeah, we support them in similar ways. It's obviously still at a much earlier stage. So the advantage that a network like Angel Academe has is that we've got a very large diversity of backgrounds in our network. So we start by trying to support the businesses that we look at pretty much from the go, by helping them to optimize their pitch, giving them thoughts about their tools and along the way, but obviously as far as we can by introducing ideally clients, other investors and the like. And that is very powerful. And what we're trying to bring across is that we want the businesses to succeed, whether they become our portfolio companies or not. And I mean, the most tangible example is obviously I've joined the board of Scale XP, where we help the founder Susanna Holmes along the way with the strategic thinking, with introductions to clients, but potentially also to other investors. But it is really the diversity of our backgrounds that gives us the opportunity to be relevant for our portfolio companies. And that is also where my experience comes in, where it is very powerful to be part of an investment network, because obviously by yourself there's only so much you can do. And so as an angel investor, I highly recommend to be part of a network, and also make sure that the connections outside the network are fresh and viable. But what do you do when things go wrong? I mean, does the relationship change, or do you have a silver bullet to help your companies?
Yeah, that's a really good question. Well, as I said earlier, like it really is a marriage between the investors and the founders, and the relationship is meant to last for a few years. So obviously we are, like here, and the relationship is not damaged in good or bad times, like, and also I think, an advice for the people who are listening to us today, I think, like the shareholder agreements, we often say it's a marriage contract, but it's also, the terms for the divorce in advance. And so I would really recommend not to fully delegate the negotiation of the terms to the lawyers. Like, I would recommend to fully understand the terms and the implications behind it, because it's super important. And, you know, like, oftentimes founders really focus on valuation more than terms. And I would, you know, be really careful not to pick the wrong battle, because, you know, valuation is a signal that people love to post on LinkedIn, but nobody posts about, you know, preference tax or, you know, other terms that are equally or even more important. And, you know, an example that happened recently for us, we just closed the deal. It's not announced yet, but we actually signed a 30% discount on the valuation via other term sheets that the company received. The reason why the founders chose us was, you know, just our value proposition in addition to the relationship we built and what we believe we can build together over time. So I think that's super important to keep in mind. And, you know, at the end of the day, like, we are nothing without the entrepreneurs. Like, we are not the ones that, you know, have hands on the wheel on a daily basis. We are here to support, really. So if things go wrong, we are very much aligned. Like, we don't sleep either, and we are here to, you know, like, support. It happened to us in a few cases, you know, to help find potential buyers, to make sure employees don't lose their jobs, or to help them finding other positions. So that's really part of the job. What's your view, Alex?
For your cooperation is obviously the other investors, isn't it?
I would love to,
yeah.
Sorry,
it's because there's only so much additional funding that we can provide, and I'd argue the support, when things go wrong, it very much depends on the reason and on our level, whether it's the misjudgment, developments business can change, and crisis can happen, for as long as it's in good faith, and there we obviously try to be as supportive as we can, but more often than not, if the business progresses very rapidly, then the burn rate increases to a point where the average angel investor will not be able to bail out the company. So obviously what we can do is we can step up our introductory efforts, we can step up our advisory efforts, but it's very difficult to single-handedly bail out the company. But one of the key challenges for the angel, and that's where my flippant comment earlier comes from, is obviously when the VCs come in. So that is where the company is changing to a different level of maturity, also where the investors, when the founders' interest moves on. And so that is where we have to be particularly vigilant to make sure that our rights are protected. It is a very exciting time for us, but it's also a very dangerous time for the angels. And that's where it becomes incredibly important to see who we're doing business with, VCs with a good reputation. And that's where, as Victoire said earlier, need to really element of the term sheet and of the shareholder agreement. And Victoire, how do you see how the link between angels and VCs work?
Yes, I mean, you know, we really like to work with business angels. You know, like, it really makes sense. Even in a seed round, it doesn't have to be that early. In a seed round, it's super great to have, you know, business angels who are domain experts. And so in these cases, we would be investing in the same round, so it would be the same timing. But then I've seen a lot of cases where the business angel would still be around the table, like, you know, they would still sit at the board, maybe not, you know, having a board seat, but be an advisor. And yeah, I think, you know, it's actually adding a lot of value. So I mean, I can't say anything else. Like, we really like to work together with business angels.
Okay. One point that I do want to tap in before we move to the questions is, I mean, Angel Academy, as Sarah was saying in the beginning, was bringing female-led businesses, helping them grow, making them accessible, providing them with capital, but also making these opportunities more accessible to female investors. Is diversity also something that you're looking at?
Definitely. I mean, you know, being a female investor myself, that's definitely key. Well, the first thing, you know, and it's super important for us. Like we actually start with ourselves as an investment team, and so we are really attached to the idea of having a diverse investment team, and not only gender, by the way, diverse on a broader definition, because we believe, and also we observed that, you know, diverse team really helps attracting diverse deal flow. Like obviously, you know, when you're a female investor, it can feel a bit easier to touch base and to catch up with female founders and just have an informal discussion and not feeling, you know, like as much as, you know, cooked you can be, you know, in different situations. So that is the first thing. And, you know, it's fully part of our pipeline and investment process. Like we have this key objective of 30% diverse founding team along the pipeline, and that is really like the team's topic. It's not like one person in the team that's responsible for them. For that, it's really like included and fully integrated, and also, you know, we signed the UN PRI. Do you say that in English? We say PRI in French, but I'm not sure for English. PRI, yeah.
Yeah.
Surely that. Okay. And so
I haven't personally signed it.
Well, let's say it's UN PRI, and that actually, you know, we have an obligation of reporting as well by being a member and signatory. So that goes up to our LPs reporting, which is super important for us. And yeah, one thing I would like to mention today as well. We also worked on an initiative which is called Women in Wealth Tech. So we basically created this group of female founders, head of in the fintech and insurtech fields. And we have roughly 100 members today. It's on Slack. It's really informal, but the idea was to provide them with a safe space to, well, learn from each other, meet with each other, ask questions. And we also organize sessions like this one today with experts, domain experts that will bring them tangible advice. So, I mean, that's a side note, but if anyone is interested in the room today, I'm super happy to share the link to subscribe to, you know, Sarah or Simon later on.
Brilliant. Okay, on that happy note, I think, Sarah, are there any questions, or Simon, are there any questions that we can help answer?
Indeed there are, indeed there are. So a follow-up on, this is from Sabater, a follow-up on your point about founders. You covered this a little, but it'd be good to go into it in a bit more detail. I mean, around some of the key attributes that you see in successful founders or founding teams, and supplementary to that, are there key differentiators in fintech founders specifically?
I'm happy to start. Well, you know, like the fintech sector really is a technical sector where you need to have domain expertise, and, you know, it's also a sector where oftentimes companies need to be regulated. So what we like really are, you know, teams where the founders have previous experience in either, you know, a corporation or just, you know, having been an operator in this sector before, so that you know what are the needs and you know, the pains really. So yeah, that's why, you know, repeat founders, either they, you know, they've launched a company before on the field, and so they just are super used to it, or, you know, like just have been doers beforehand, and yeah, know the pain. That's super important for us.
Yeah, the ideal founder has automated in their former day job, so that is the ideal scenario. But more often than not, it's mainly the red flags that determine what makes a good founder. So the absence of red flags. And so on top of the points that Victoire was making, I would say, especially the people who have a good understanding of their valuation, a reasonable valuation, and of their competitive field. So the ones that come in with ludicrous numbers just because they have a buddy in the Silicon Valley, those things don't work. So it should be a reasonable discussion where the founder is able to explain in very simple word what the product or service is addressing.
Yes, and you know, it's not even playing in their favor. Like, you're building an equity story that you will need to sustain over time. And so when you raise a pre-seed or a seed, I'm thinking of, you know, some YC companies sometimes that come to us and ask for like a ridiculous valuation. And at the end of the day, like, we spend a lot of time explaining that it's not necessarily the best bet to make, because then, you know, next time you're going to raise, you need to justify 3 times this valuation, and then you will have KPIs to show. So like, if I were to be an entrepreneur and if I were to raise my first round, I would make sure to keep it like really reasonable, because then it's much easier to justify the valuation for the next round. And you have roughly 18 or 24 months to execute on that plan. So yes, it's really like, it's trendy today to post on LinkedIn your crazy valuation, but honestly, like, how many companies that can't sustain that, and then later on they need to raise a downsized round, which is terrible, because then, you know, dilution is much higher.
Yeah, sure. So Alex, tell us about those red flags that you look out for.
Well, an obvious one is a founder who doesn't engage, who essentially the worst ones are the ones that ping an email around bonus time saying, hey, we've got this great opportunity. Here's the deck of 8 slides. When can we expect your money? So that's obviously a no-go. So the ones that do not want to engage in discussions of the business models, of the forecast, that are hesitant to or well, negligent in disclosing the existing legal agreements. A big red flag is obviously where funding is used to cover outstanding liabilities, and more often than not, I've come across businesses that have essentially had rent-free periods and that said, oh, after the fundraise, we pay you back, or had employees working for free and saying afterwards, you know, you get the very extra. That is not something that we as an investor want, because it's obviously not forward-looking. The other point is that is more relevant in certain regions of the world than others, and that's well, family businesses. So I would not want to invest in an existing business that has traditionally too close links, or it has even prominent investors, because that means that the eyes off the ball as an outside investor, we are struggling to have our points heard, and also potentially our criticisms accepted. So those are the typical points. And I mean, if one of the pitch events is an expensive membership club in Mayfair, that normally reflects badly on the financial discipline, unless it's obviously a very sociable business plan. Those are some of the typical points. Any particular red flags for you, Victoire?
I would just, you know, follow on what Alex just said on, you know, like data sharing. I mean, again, before Portage, I used to work in a pre-seed focused fund, and, you know, like founders that would come and ask for an NDA when there's only 8 slides. I mean, you know, at the end of the day, it really is not about the idea. It really is about execution plan. And so you can have the best idea of the world. Like, you don't really need to protected, because it's going to be really about like hiring the right people who are able to execute that plan in the first place. And yeah.
Okay, so I think it's about 8 months ago, a VC said to us, probably being a little bit provocative to be honest, but that the only business model that counts is the ability to raise funding, growth at any price. Is that still the case?
I mean,
as to either of you.
Victoire, you go first. Will you go first?
I mean, you know, what do you mean by raising at any price? Like valuation, just?
Well, you know, we are in this situation, aren't we, where and not just for fintechs, but you know, broadly in our space, the focus seems to be on you know, growth, and often over any sight of profit. And just wondering if that is beginning to change, particularly, you know, with the economy possibly taking a difficult turn.
Yeah. I mean, you know, I think that's a point I made earlier on, you know, like us being very unit economics driven, and we actually see investors, you know, moving towards that and being super like thoughtful about trajectory to being profitable, as well as the runway that the company will have. Like now we hear investors asking for at least a 24-month runway to make sure you can execute, and if anything goes wrong, you have enough time to flip around. So yeah, that's, I mean, obviously being more and more important. I don't know what you think, Alex.
Yeah, it's I mean, we're obviously coming at a much earlier stage, and sometimes when the product is barely at MVP stage, so then obviously the founder should focus that the product is viable, but from then on, signing up customers is a proxy for proof of concept. And but it depends on the quality of this growth. If it's just by signing up customers for free, and there is a high underlying churn rate or very low conversion rate, then you know it's not worth it. And because the questions that we see increasingly often is the path to break even. So yes, growth is incredibly important, and solid growth rate would be the first bullet point, but it doesn't work if at the same time the underlying product or service is not foolproof.
Okay, thank you. We've had a great question in from Laura, actually, which is returning to the red flags, but actually, but turning it the other way around. What should founders be concerned about when they're looking to investors, and possibly especially VCs?
No, I think, I mean, when you're, you know, when you're looking for, you know, the right partner, I think it's, I mean, if I were a founder, I would definitely ask for, you know, a few contacts in portfolio companies I can speak with and ask about their experience with the VC. I think that's the best due diligence you can make. Like just going to a few CEOs or, you know, C-levels in a few portfolio companies and asking them about, you know, how was the relationship and what was the value proposition. I think you can't have a best testimony than this one.
Yeah, and just from my side, I've seen it from the founder's perspective recently, and it's in the term sheet, and the founder will stand out. I mean, there's an extensive list in the book Venture Deal by Brett Feld and Jason Mendelsohn. So I cannot recommend this book highly enough for founders looking to bring in VCs on that level.
Okay, thank you. Actually, on the subject of books, are there any you particularly recommend to either founders or potential investors in this area?
I hear
Didn't you have one?
I hear Sebastian Mallaby is writing excellent books. I mean, you are. I haven't read the book. I only learned recently about.
I'm sure you heard about it from someone that knew what he was talking about. I mean, actually, away from the books thing, are there particular influences in the area that you think that, or you know, bloggers that are important to follow?
So, I mean, one thing I would like to say is, you know, like, I think Twitter is an amazing place to educate yourself. Like when I started looking at cryptos and Web3, I started following a few investors in this field. And I think, what I really like about Twitter is that it's not really about personal branding as it can be sometimes on LinkedIn. It's all about content. And so you can follow people with like super interesting threads about a specific topic, or, yeah, I think that's a really good place to start when you want to learn about a topic.
Yeah.
Okay. And if anyone can tell me what Web3 is, I'd be very grateful to you.
Yeah. Fintech Fridays on Clubhouse is very American focused, but they're talking about the leading trends. They have institutional investors there. So they marry the two perspectives, the wild dreamers and the various established VC investors. So I can recommend that.
Okay, thank you. And thank you for getting in a mention of Clubhouse. It's about the first time I've heard of Clubhouse in about 6 months now.
I know, I know.
What happened there? Okay,
yeah.
Look, we're pretty much out of time. I just want to put one last question to you both, which you touched on, but it'd be good to go out on this, really just about any really, really exciting frontiers in fintech at the moment. Obviously exciting opportunities. What are the monorails and jetpacks out there that we've yet to invent?
You want to start, Alex? Oh.
Well, I'm very excited by the opportunities that come from the blockchain space. I mean, that sounds very cliche, but people used to compare it to the HTTP protocol, that the expectations early on were very high, and before we knew it was everywhere. And I think the opportunities there are very exciting, and in ways that we haven't thought of. So anyone who's been trying to transfer money internationally will know that there is a lot of hurdles still to be taken, and anything that automates the payment process there's a lot of fields in that space. And then obviously, and I'm talking my own book here, the identity management in the way that Nuggets is addressing it.
Sure. And Victoire, last word to you on that.
Yeah, it's super interesting that you said that, Alex, because it's the exact same topic I'm working on currently. I'm specifically working on an investment thesis on B2B cross-border payments and infrastructure. And we looked at it from so many different angles, and we did look at cryptos and blockchain for that. So yeah, I mean, we think that blockchain is a tech evolution that's, there's so many things that can be built, and opportunities are just so interesting. And at Portage, we have invested in a few companies already. All of them are infrastructure plays applicable to cryptos and blockchain. Yeah, very, very exciting space.
Great. Okay, well, thank you so much. I'm going to bring Sarah back in at this point. If you're there, Sarah.
And you're going to show my last slide.
I am
just
indeed.
Some sort of
okay.
Follow-up information about Angel Academy. Thank you so much, Alex and Victoire. We haven't managed to answer all the questions, but it was a really great discussion. So interesting to hear from you. And everyone on the line, if there's anything you missed, we'll be circulating a recording soon. Actually, it will go on our YouTube channel. Any founders on the line that are interested in pitching to Angel Academy, applications need to be made online. If you're interested in joining us as an angel investor, Michelle, our network manager, can give you that information. And we've got various information sharing, brand building projects going on. So we have our Substack newsletter, we have a LinkedIn page, we're quite active on LinkedIn. We also have a Twitter account as well. And we have a YouTube channel. So I'll leave that slide up there so that people can grab those URLs, because they're not that handy, are they? But if you search on YouTube for Angel Academy, that should come up, and likewise LinkedIn. But thank you all very much for tuning in this afternoon. Thank you again to our speakers. Thanks, Simon, for chairing the questions, and hope to see you all again soon. Enjoy your evening.
Thank you, everybody.
Thank you. Bye-bye.
Bye.